focus on LIC, which has reported an operationally strong performance in the quarter gone by as margins expanded sharply. My colleague Anurag Shah caught up with R. Doraiswamy, CEO and MD at LIC, to discuss their second quarter earnings performance and the outlook going ahead. Let's go across and listen into that conversation.
We have done well on the profit side, no doubt about it, and we have also showed a growth on the APE front for the half year. You are aware that the last year on 1st of October, the new master circular was rolled out, and keeping in view of that, in line to the provisions of that circular, we had made a lot of changes to the existing product portfolio. So that resulted in our having the need to increase the minimum sum assured, and the policies which were very popular, we had to increase the ticket size. So that has resulted in a kind of a degrowth in a number of policies sold during the second half of the last year, and that continued. The impact had an effect in the first half of the current year as well. So the premium growth was muted, as you said, but the profits we could still have a good number thanks to three reasons. One, the business portfolio, the core operations had improved. One. Two, we had a reasonable support from the investment income. That is the second contribution we had. And third, the rationalization of the expenses has continued. So there has been a reduction in the expenses. There has been improvement in the investment income, as well as the core business has also contributed for the profitability of the organization. So overall, we could show a good growth in profits, though the premium growth has not been matching with that.
Okay, sir. But sir, another highlight is non-par share. It has reached to 36%. So what has contributed in it? And now you're targeting more than 36% also?
See, you have been hearing us from the time we went public. We had a directional change. We started focusing on guaranteed products.
And if I'm right, sir, during your IPO, it was less than 10%,
yes,
right?
Yes.
Yeah.
So we started showing a good traction on the guaranteed products, which also attracted the interest of the customers as well as the intermediaries. We have launched good products, and in the last 3 years, we have a good number of non-par products which have been launched. And also, the customers are now very comfortable talking about unit-linked plans. So both our, all put together, there has been a good traction on the non-par, and we have been steadily increasing our non-par share. And as you said, it has just reached 36.31% as on 30th of September. We have created enough momentum that I expect that this improvement may continue for some time. But we are now, we can think of getting it stabilized somewhere near about these numbers that we have reached. There can be some more improvement also that can also happen.
So target is there to reach more.
We don't keep a target as such. Okay, we wanted a sustainable, profitable growth for the organization. So we bring out products which are in the interest of the customers and which customers would like to avail. So we leave it to the choice of the customers for them to buy, and we focus on need-based selling. So whatever customer prefers and whatever is the flair of the market is what we'll have to continue to focus on.
Okay, sir. Now, my another question is related to the VNB margin. On that front also, you are growing. So for this financial year, what VNB margin you are targeting? Can we expect that you will be about 20%?
We don't keep a target in mind. It happens every year that the VNB margin starts increasing from quarter 1 to quarter 4. It keeps increasing quarter to quarter. So currently it is at 17.6, which was the figure that we had for the entire year last year on 31st March. We expect the margins to improve further in the third and fourth quarter as well, but we'll have to see how much it can go up. We will not be able to predict a number right now, because we have to also factor in the input tax credit also that has to happen.
Yes, sir.
But we are hopeful that this will be improving further, and it can be better than this in the remaining 2 quarters.
Okay, sir. You just spoke about the input tax credit impact, sir. So, what will be the quantum of ITC impact? Because after the GST reforms, you won't be getting ITC on the individual policies.
See, we will have to wait and see. See, the entire thing depends on the kind of expenses that we have. Our commission expenses depend upon the product mix and the kind of and the premium that we get from the different channels. We don't expect a big impact, though ITC will be having an impact certainly. We are expecting to compensate the impact of ITC by continuing to focus on rationalization of expenses, one, and this decision of the government to exempt individual life insurance from GST has given a fillip to the entire market.
Yes, sir.
One, so it has become a bit more affordable, and we have, as an organization, we have decided to pass on the entire benefits to the customer. So it is going to be resulting in a good growth in the top line. That's what we are looking at. So a combination of top line growth and a continued focus on rationalization of expenses should help us containing the impact of input tax credit loss, which we may have a small impact, no doubt.
Sir, you said rationalization of expenses, but LIC is the only company in whole life insurance space which has not reduced commission for their agents and for the partners and distributors. So what's the strategy behind it?
See, on 1st of October itself, we had done a realignment of some commission rates.
Last year. Yeah.
To be in alignment with the master circular provisions. So we still feel that the agents' interests also need to be protected in a very competitive industry like ours. While we pass on the benefits to the customers, there will be, of the GST reduction to the customers, exemption to the customers, we will have to even balance the interest of our intermediaries as well as the customers. While the customers' interest we are completely protected, we are also trying to take care of the agents in the interim period. We will be looking at improving the top line using the benefits that have accrued to the customers by way of GST exemption, and improved ticket size, increased top line, and continued rationalization of our expenses. Our operational expenses will result in a situation where we will be able to manage the situation. That's what we are looking at. But as a dynamic market, we keep examining the positions from time to time